This is James Hirecheck with this week's Autochartist weekly Forex futures and indices market update for the week ending August 17th, 2012. For several weeks, the focus in the Forex market has been on the euro. In the meantime, the GBP USD, or British Pound US Dollar, has been forming a solid support base with these rising bottoms, and there's been a slight bias to the upside. The possibility of a near-term breakout made it the Forex market to watch on Tuesday, August 14th. The British pound was approaching an Autochartist Key Level resistance at 157.80, this line here across the top. This price level has had a major influence on the currency since late 2011 and has proven to be an important resistance level several times since then. After forming the top in late April, the British pound sold off from 163.01 into 152.68. This range created a retracement zone at 157.84 to 159.06. So besides these tops here at 157.77 and 157.67, there's also resistance up above here at 157.84 and 159.06. The other market we were looking at was the Australian dollar, US dollar. What we saw here was that a rise in U.S. interest rates has encouraged investors to adjust for the interest rate differential between the U.S. dollar and other higher yielding assets. This made the AUD USD, or Australian dollar US dollar, the Forex market to watch on Wednesday, August 15th. The rise in U.S. interest rates and the weakening Chinese economy helped form a top in the Australian dollar, setting up this decline here and possibly into this support level of this pattern. So we're looking for a possible move into the 103.81 area. If it goes beyond this, we could be looking at a substantial break, as there is plenty of room to the downside. So again, rising U.S. interest rates coupled with the weakening Chinese data is putting pressure on the Australian dollar, US dollar, and this could lead to further decline this week. Now later in the week, we switched our focus to the 240-minute chart for the Euro US dollar. And the reason for this was that we were looking at extreme volatility in the euro last week, and so we felt that we were set up for continued volatility, but perhaps be safer to trade off of a 240-minute chart. We're looking at a very shaky market right now. We saw this big move here in late July, stopped short of this resistance zone around 124.66. And then what we saw was a further decline into a retracement zone of this rally. So now we're camped out here in this series of retracement zones, and that's causing a choppy two-sided trade. The bigger charts indicate that there is still a bias to the downside. However, this daily chart still indicates that we could be looking at another attempt to rally into 124.66. because of this higher top, higher bottom formation. So to be on the safe side, I would switch to a shorter time frame and leave the 1440-minute chart to the professionals right now. The way this market is swinging both sides of the pendulum, it's probably safer to trade a shorter term pattern. Be flexible enough to trade both sides. A break under 122 could indicate sharp break to the downside, while a rally above 124 could indicate a move to 124.66 and beyond. This has been James Hirecheck with this week's Autochartist weekly Forex futures and indices market update for the week ending August 17th.